talking about the minutes, they're out later. Tell us what's going to be in them.
I can't comment on the minutes, but it'll be
surprise.
Thorough discussion of all the issues, macroeconomics in the U.S.
Okay, but more seriously, let's really start and drill down to the bottom and the St. Louis Fed president. Now, soybeans, a trade conflict, you've got a big soybean farming community there. How do you look at that?
Well, our farming community is very concerned about the trade war and the soybean issue, and exports are, down a lot if you look at the charts. And of course, the government's trying to come back and offer some payments back to farmers. Those are usually considered barely enough or not enough. And so I would say overall, U.S. agriculture is not one of the stronger sectors of the U.S. economy. We've got other parts that are doing very well, but probably not the agricultural sector in the last couple of years.
So is that something which do you think will be reflected across the board? I mean, this is something you've got to be concerned about. How, because it's such a salient and important headline-grabbing thing here, how much do you think about the trade war as a Fed body?
Well, it's an important issue. I think for this to actually affect Fed policy, these tariffs would have to stay on for quite a while, something like 6 months. And at the end of 6 months, if there was still no prospect of a resolution, then I think that's the point at which it would start to really weigh on Fed policy. But at this point, we're just talking, we're too early in the process, so it's premature.
Jim, you say that, but people hold off from investment. People have this wait-and-see approach, and that in itself is probably even more damaging than having the certainty of what those tariffs are.
I agree about that. And, I guess my sense being over here is that the Chinese side would benefit a lot from getting this deal done. And you'd incite more confidence and investment in China and more of the feeling that they're going to protect foreign investment. And I could see a boom in China coming after a deal.
And if there's no deal?
If there's no deal, it's an export-led economy. It
It's changed,
but it doesn't bode well for the Chinese. So I think this is a great opportunity, actually, for China just to sign on to international norms on trade policy.
Okay, I mean, I was going to ask you this later, but this has caused RMB weakness. Does the yuan going below 7 or above 7, weakening above 7, affect your thinking in any way?
Well, we certainly track exchange rates all around the world, but this would not come back directly, I wouldn't say, to U.S. policy.
Okay, but a China slowdown certainly would hurt you. And how would it hurt you? And how can you mitigate it with monetary policy at least?
China's obviously become very large as an engine of growth in the global economy, one of the 4 largest economies in the world, depending on how you want to cut it up. But we very much have relied on Chinese growth in recent years in the global growth picture. U.S. has gotten better just recently in the last 2 years, but we're all counting on China to be an engine of growth internationally. So I think it would hurt if they retrenched and started growing more slowly.
Okay, let's dovetail back to the U.S. Tell me about where rates are.
Rates are at a good place in the U.S. right now. If anything, we're a little bit restrictive, I would say, and I am concerned that we may have slightly overdone it with our December rate hike, but I was pleased that the committee pivoted. The current projections from the committee are for the policy rate to remain flat during 2019. We've got very low inflation numbers, or low inflation numbers, and low inflation expectations. That's a little bit concerning to me. And, I think that could be used to justify a rate cut at some point.
Absolutely. Markets factoring in perhaps some market indicators, 1 or even 2.
Here's the thing about that issue. We've had 2 years of great upside surprise in the U.S. economy, that growth turned out to be better than we thought, unemployment lower than we thought, everything coming up roses on the real side of the economy, and yet inflation's really not at our 2% target based on our preferred measure, which is this core PCE inflation year over year, which is only 1.6 right now. So I think gives me pause that that's so low, and it does give me more pause that the inflation expectations are below our target. So why aren't those centered right at our 2% target? I think we could take this opportunity maybe to try to recenter inflation expectations at the 2% target and gain credibility for our target.
Okay, but I think you in a newspaper interview recently, you used the word persistently at 1.6%. What is the definition of persistent? 1 month, 4 months, a year?
I think at a minimum, you'd like to see what the second quarter of this year brings as far as inflation news, and we won't really have all of that information until you get to the August, September timeframe. It could be that there's just noise in the data. It's always possible, and this thing might bounce back, and then you wouldn't worry about it. But if it doesn't, and it looks like we're going to miss our inflation target again in 2019, I think that's what gets very concerning. It looks like 2019.
Miss it to the downside.
Yes, miss it to the downside, and really, inflation has been below target since 2012, more or less consistently. Why is that? It seems like we should be able to hit our inflation target over that long of a time period. So I don't want these inflation expectations to get entrenched in the U.S. economy and globally, that people think that the inflation target is only 1.6%, which is kind of the average inflation rate over the last several years.
Just a bit on targeting, though. You've been an advocate of long-term rate targeting. Well, it would have been an easy job, of course, just a couple of years ago. But seriously, though, looking further down the line, many people are critical of this. Why, and why do you want it?
Are you talking about like yield curve control?
I'm talking about yield curve and long-term rates, nominal rate targeting, which is something you're against, I think.
I guess what I've said on this, I think, again, the Japanese have been leading the way as far as new ways to run monetary policy, even when rates are very low. They would claim that it's been successful. I think it has been modestly successful. They still haven't hit their inflation target, so that's an issue. But, the issue about targeting longer-term rates goes back to the 1940s and World War II when the U.S. did this. And coming out of the war, we continued to target long-term rates. It didn't end well, and ended with a lot of inflation. That's why it's been a sour issue in the U.S. is thinking about that experience from a distance. It didn't work very well. But the Japanese are showing that maybe you could do it in the modern world, and then you wouldn't have to do the asset purchases at such grand scales as we've been doing them. That would be the idea.
Well, they haven't hit their target, as you said, and
right.
The white body of thought they're saying they never would. But I'm going to just go back to your job and how many of your colleagues on the Fed board have been on the FOMC have been talking about, especially Jerome Powell, using the word transitory for inflation. Transitory in a low sense. Yeah.
So
But you said it's going to be persistently low.
I think just to put it in perspective for our viewers here, the 2017 experience, that was one where during this time frame in 2017, inflation came in below target. Janet Yellen was chair. She said, I think this is going to bounce back. You waited a whole year into 2018, and indeed, it did turn out to be transitory, and we did get back to our 2% target. But now it's unclear whether you want to tell that story again here after 2 years of upside surprise in the U.S. economy, unemployment, 50-year low. I mean, come on.
I'm just saying this absolutely looks wonderful. Now, on paper at least.
Yeah.
But tell me something here. You guys on the FOMC, not of course that you were even part of this, during the financial crisis, looked at money supply, especially M1 and M2, very closely.
Yeah.
You don't seem to do that as much now. And if you look at M1 and M2, you see M2 going down, money supply going down. Now, that is normally indicative of a low inflation environment, one which will remain in a low inflation environment. Now, so why are you not really talking about that as much?
Yeah, I mean, St. Louis Fed has kind of been the monetarist Fed over the last 50 years, but it's been a very tough issue. I do think M2 on very long-term trends is helpful, but as far as helping on a quarter-to-quarter basis, probably not that useful. we do need to supply the right amount of money to hit the inflation target, and we try to do that. I think you'd have to have a deeper analysis of M2 to see what's going on there.
Okay. Now, again, have we reached with where we are? If we, let's say, had a quarter-point cut out of the Fed, how much difference would it make?
Well, I think if we cut a quarter point in an environment where the U.S. economy is surprising to the upside again in 2019, that would probably send a signal that we're serious about hitting the 2% inflation target. We're serious about, we want the average inflation rate over a period of time to come out to 2% on our preferred measure. And we're willing to tolerate somewhat higher inflation for some period of time in order to get the average to come out to 2%. So I do think it would be an important signal to markets if we get to that point. I don't think we're there yet. I think it's premature at this point, but this is something that could be done, possibly.
Okay. But does this also, with the length of that answer and how you went around, does this also perhaps reflect the limits of monetary policy now? And not just for the United States. With the amount of bullets in the chamber expended to combat the GFC, where does it left you guys?
Well, the normalization in the U.S. has been quite successful. We've moved the policy rate off the effective lower bound. We're up some 225 basis points. That's very similar to other tightening cycles in the U.S. They seem low. Rates still seem low, but they're high compared when you're looking at zero and negative rates and other
real rates
low in other economies. So we've managed to normalize the policy rate. I think that's great. We've managed to reduce the size of the balance sheet. Reserves are down some 45% from where they were. There are other issues with the balance sheet, why we can't get it any lower, but we have reduced the size of the balance sheet. So I think we've put ourselves in good position, should there be another downturn somewhere down the line, that we'll have enough ammunition to handle a recession should it come around.
But my point would be, the question is, there are limits to fiscal monetary policy, and talking to a monetarist Fed, what about fiscal policy? How much more heavy lifting has to be done on that side by the government through taxation, etc.?
Well, I would prefer that taxes be set for the longer run because of...
You would do?
Yeah, because they do tend to generate uncertainty in financial markets. Investors get worried about that their taxes are going to change at some point in the future. We just had a major tax bill in the U.S. At the end of 2017. And so I think it's probably not too realistic to expect further reform there. I think that reform was very successful. It put the corporate tax structure in the U.S. in the middle of the pack as far as the OECD is concerned. I think that was the right thing to do.
But does fiscal policy need to do more of the heavy lifting now? That's my question.
I mean, I think it's a pipe dream to think that fiscal policy is going to react on an 8-week cycle to developments in the economy, and that you're going to get Congress or any other parliament around the world to react in a timely manner. That's just not, it's a pipe dream. The politics are not like that. It involves negotiations among all kinds of people in the various economies to get those things to happen. So I don't think that it's very likely that you're going to get fiscal policymakers reacting to day-to-day shocks in the global macroeconomy. What they can do is set an efficient tax structure and spending structure that meets their priorities and keep their long-run fiscal situation in balance.
Okay, we saw where the GFC came from. We've got a quite leveraged loan market now as well. How concerned are you about that?
Yeah, I know the chair just talked about business lending in the U.S. and that's a moderate concern. I agree with the chair on that. We'll have to watch it and track it going forward. Sometimes these things can get away from us and turn into unintended consequences. I think that would be the concern here. On the other hand, corporates can decide how they want to finance themselves through equity or debt, and if they want to go more through debt, maybe that's a business decision and not so much a macroeconomic concern.
Jim, what are you most worried about at the moment? economically speaking, for the US or even globally?
Well, I sleep pretty well. I don't think I think we're in fairly good position right now. We do get paid to worry, so we worry all the time. But if you want to talk about something like future financial crises, I would say they'll almost certainly be generated outside the banking system, and probably with all the tech and payments initiatives going on all around the world, there'll be some unregulated sector that will be the source of future problems. So that's what I worry about.
Which comes out of left field, doesn't it?
Absolutely, absolutely.
Okay.
Yeah.
So what would be the worst mistake you could do right now? I mean, there's several you can come up with, I'm sure, yeah.
I think the committee did a great job of avoiding what I think would have been a big mistake, which was to try to push U.S. interest rates considerably higher from here, like 100 basis points higher from here. I think that would have been a mistake. I argued, I've been arguing for a couple of years that we should take it very slowly on raising the policy rate. And to the chair's credit, he pivoted starting on January 4th in Atlanta, and that's continued from there, and we're in a better position today.
Jim, 10 seconds. Was the December hike a mistake?
I argued against it at the meeting, but I certainly respect my colleagues' decision-making, but I did argue against it.
Yes or no? Well, sorry, it's not a yes or no answer. In fact, we run out of time. But I was going to ask you, what is the natural or neutral rate?
Mine's about 2%, so we're a little bit tight right now.